Hello, I'm Russ of the Dapper Dividends YouTube channel. What's up? Thanks for coming on back. Come on, get in here. I got something to share with you. It's every stock almost that I bought and sold in 2024. But before we get into it, I am not a financial expert analyst. I have no financial accolades whatsoever. I'm just a welder sharing some of my passion for passive income on YouTube with you. So none of this is financial advice, but I'm gonna share it anyway because they allow me to. And I also share it in a free and fantabulous weekly newsletter where you can sign up at DapperDividends.com or click the link in the video description below. And if you want to be alerted to my trades every day, then also click the link in the description for Blossom, where some fun and fabulous people like Ryan Williams and Ian Lopik are also at. And also, if you want to see the portfolios, you can go to DapperDividend.com and just click portfolio, and you'll be whisked away to GetQuinn.com, where you can indeed get a live look in on all the positions anytime you want, night or day. And share with us in the comments below if this happened to you like it did to me when I worked at Farmore and you got paid in cash with a gun on the table. Also, be sure to stick around because as soon as I'm done telling you about everything we bought and sold, I am also going to share with you one of the stocks that is high on my buy list. These are the buys. I sorted it by projected annual dividend income gain, and as we'll see, loss from what I sold, with the smallest to the biggest. First one up is Clear Secure, ticker YOU. This is an exploratory position. I don't know if I'm going to keep adding to it. I've hit the pause button on it. I worry about TSA and their pre-check expanding, encroaching on Clear Secure and kicking them out of the airports. You know, that's what Clear Secure does. They help people get checked in really quick, skip the lines. So I worry about that. They are trying to expand to sports stadiums, tool rental with Home Depot, Uber. I'm not too sure, and I'm still chewing this one over. But Clear Secure, ticker YOU, gave us $5 in projected annual dividend income. Now, when you see these in red, it means that I ended up selling this year, but I still bought this year, so I put it on the list. And I also did not include a few things like SWVXX because I look at that as kind of like a savings account. It was a place to park some cash. We did buy ticker SCHG, the Schwab US Large Cap Growth ETF, 15 shares of that at an average price of $90.16. Now that was before the 4-for-1 split. I didn't split adjust this. And SCHG gave us $6.60 of P.A.D.I. Kind of anticlimactic because you know that we ended up selling it, right? But hey, we did an exploratory position with Diageo, ticker DEO. 4 shares, average $140. That gave us $16.48 of P.A.D.I. But, you know, I chewed that one over as well. And from things I see, it doesn't look like as many young people, the Gen Zers, don't really drink that much. They're a bit healthier. Probably a good thing, although they own Guinness. Big fan of Guinness myself. I've given Diageo a lot of money in my lifetime, and I will continue to do so, but I didn't feel comfortable holding this one after we did that exploratory position and we ended up selling, which is good because we sold those at $148 and Diageo's in the mid 120s as of this recording. 49 shares of SCHD, the Schwab US Equity Dividend ETF, at an average price. Now this one I did split adjust, $26.44, gave us $48.51 of P.A.D.I. Everyone talks about SCHD to death, so we're going to move on to 13 shares of Nexstar Media Group, ticker NXST, at $155.26. That gave us a P.A.D.I. of $87.88. Now, we had bought 30 shares of Toronto Dominion Bank, ticker TD, at an average price of $60.19, which was good for almost $90 in P.A.D.I., but newsflash, anti-money laundering, they were apparently laundering money for Asian drug cartels. Big no-no. They got bit and caught with that by the U.S. government, and they have fined them a couple $2 billion. They have kept their U.S. growth indefinitely, so we don't like to see that. too much controversy for me, and I ended up selling Toronto Dominion a little bit later after we bought these shares. This was a new position, 65 shares of Nike, ticker NKE. I've shared a lot of thoughts on the program about Nike. Average cost $76.91. As of this recording, they're sub 75, and I am liking that. Our plan is to get to 100 shares. And this is one that we likely will start selling covered calls on to generate extra income. And that gave us $104 of P.A.D.I. Now another new position, Visa, ticker V. 45 shares at an average cost of almost $270, $269.59 to be exact. That gave us $106.20 of P.A.D.I. And I know they don't have a very big starting yield, but they do grow that dividend very quickly. 54 shares of Starbucks at $76.53, ticker SBUX. They've also been covered a lot by the dividend community, but that gave us $131.76 of P.A.D.I. Ticker MLPX, the Global X MLP and Energy Infrastructure ETF. This holds, it's a basket of virtually almost all the midstream oil and gas companies, and all that the midstream ones do is they transport, they move oil and gas. They're not affected by the price of a barrel of oil. What does affect them is how much oil moves through their infrastructure and their pipelines, how much natural gas are they transporting. That's where they make their money, and they have contracts, so you don't see them as affected when the price of a barrel of oil goes up or down. After another drop, Realty Income, ticker O, 48 shares in 2024, average price $55.20. That gave us $152.16 of P.A.D.I. Higher for longer, I think, is what really is affecting Realty Income, because that's going to make their cost of doing business more expensive. Remember, real estate, a lot of borrowing goes on there, so interest rates are really, really intertwined with their business model, and also the debt that they have to pay. If they have to pay more interest on the debt when they have to refinance it, well, that's going to be less money to go around for Realty Income. If you're following the channel, you probably already know that we sold 113 shares of J&J, but before we did that, we bought in early 2024 41 shares of J&J at $151.24. I know it's almost $10 cheaper a share, but that's what happens. $203.36 of P.A.D.I. that gave us. Next up, Agree Realty, ticker ADC, 102 shares. We built this all out in 2024, $59.72 average cost on those. I think this is one of the best REITs out there, retail REITs. I had a fantastic conversation, if you want to click this link up here, with Joey Agree, CEO of Agree Realty. They also pay a monthly dividend, and that gave us $310.08 of P.A.D.I. 150 total shares of ticker EPD, Enterprise Products Partners. This is one of what we think is the best midstream companies. Average price $28.75 on those, and that had given us P.A.D.I. of $315. But we ended up selling those because we bought them in the Roth and the self-directed IRA, which was a bit of a no-no because it's already tax advantaged. You don't pay any taxes until you sell those shares, from everything I understand, or your cost basis goes to zero, and then you start paying your ordinary income tax on those dividends, or the distributions, excuse me. VG Properties, ticker VICI, 186 shares in 2024, average cost $29.55. Much of the same sentiment with them as for Realty Income, but to keep it short and sweet, if you wanted to own real estate property in Vegas, some of the biggest names like the MGM Grand, the Luxor, the Venetian, they own almost half of the properties on the Vegas Strip, and they're also expanding into other non-gaming areas. So if you wanted that exposure, Vici Properties, I would say look into. That gave us P.A.D.I. of $321.78. And 87 shares of Harrow Incorporated, ticker HROW. Now, they don't pay a dividend. They are an ophthalmologic company. They have a lot of growth ahead of them, I believe. But because this is a passive income show, we won't really talk too much more about them. But yeah, $16.05 average on those, and I would like to get to 200 shares. So from all those buys, that gave us $2,119.70 of P.A.D.I. Now we'll move a lot quicker through these. A lot of these were consolidation sells, or in the case of J&J and PepsiCo, we needed that money to buy the car. Talked about it, written about it, pretty much ad nauseum, so you guys are well aware. So we'll fly through these. Sold 28 shares of Warner Brothers Discovery, ticker WBD. That was the spinoff shares from AT&T. $9.79. They don't pay a dividend. Albertsons, ticker ACI. We only had 11 shares, and we got $21.15 for each of those on average. We lost $5.28 of P.A.D.I. There's those 15 shares of SCHG that we sold at an average cost of $90.16, lost $6.60 of P.A.D.I. Those 4 shares of Diageo lost $16.48. Leggett & Platt, ticker LEG, 100 shares we sold at $14.05. Should have sold as soon as they cut the dividend. Because of Leggett & Platt, I now have a new rule that if the business is kind of struggling, they cut the dividend, I'm cutting them as soon as it happens the next day. Rip the Band-Aid off, just do it, because the goal here is largely dividend growth unless I have a specific reason for buying something, but we want to be dividend growth focused on this portfolio that we do share. So they are gone. They are now around $9 a share, so it was a good move. We could have done better, but lost $20 in P.A.D.I. after that cut. Energy Transfer, same reason that we sold EPD, 31 shares, $14.65 on average. That cost us $40 of P.A.D.I. Now, yeah, I don't have the gain and loss total on here for all of these, but with Energy Transfer here, it was substantial. Our cost basis was around $6, almost $7 a share. 15 shares of Duke Energy, ticker DUK, at $92, lost $62.70 of P.A.D.I. 11 shares of AbbVie, ticker ABBV. This was in a retirement account. We wanted to be a little bit more focused with the REITs and use the self-directed IRA as for predominantly generating REIT income and also investing into VTI and SCHD, which is also why we sold SCHG to put that into VTI and have more of a foundational base piece. Average price $164.80, lost $72 in P.A.D.I., and it was a little painful because it shot up to about $200 a share. Some odds and ends, LyondellBasell, ticker LYB, we sold those at $94.60, which cost us $80 in P.A.D.I. from LyondellBasell. I know a lot of you are into them, but we think they're a little too focused on commodities, the commodity price of oil, and they did file for bankruptcy in 2008, 2009, so this is the restructured company that's trading. We ended up moving on from AT&T, and of course, I had told my friends I wanted to wait until it was around 22, 23. I would have loved it there. Probably should have held out a little bit longer, but we sold 240 shares at $18.40, and that cost us $266.40 of P.A.D.I. But as we found out, AT&T, Verizon, very capital intensive businesses, highly competitive, not good when you're also paying out a really big dividend, which they have, of course, cut back. But the nature of the business is still the same with that telecom company. Toronto Dominion Bank, TD, we sold 157 total shares at $59.75. That cost $469 of P.A.D.I. that we lost. Talked about EPD, why we sold them. 250 shares total, average price $28.98. A whopping loss, $525 of P.A.D.I. And then to buy our car, these were out of the taxable account, PepsiCo and Johnson & Johnson, ticker PEP and J&J. We have extra money. We have several accounts, retirement accounts that we max out, the 401k, the Roth. We have kids 529s that we contribute to. So the taxable account was always extra money, excess cash that we had after even saving for a travel fund and an emergency fund. That's what that money is in the taxable. So I didn't sell any retirement investments. We wanted a nicer car. We've talked about that on the channel. Ended up paying for that outright with the sale of 100 PepsiCo at $158.08. Cost us $542 in P.A.D.I. 123 shares of J&J Johnson & Johnson at $147 on average, $610 of P.A.D.I. So that was a bit of a hit, but we are going to make that up. We are paying ourselves back. I have a spreadsheet that we're keeping track of all our payments going back until $33,000. That's going to be a little bit of interest on top of that is paid back to ourselves. And then Altria Group, ticker MO, we sold 160 total shares across 3 accounts because we didn't want to own a tobacco company anymore, just a personal decision from my wife and I. So we sold Altria. Plus, it's also a bit of a melting ice cube. Smokers in the United States are unequivocally dropping. So yeah, we just decided to move on from Altria, but that cost us $652.80 of P.A.D.I. And that was all for a total loss, crazy, of $3,369.32 of P.A.D.I. And subtracting that from the P.A.D.I. that we brought in, we are negative for 2024. $1,249.62. But remember, J&J and PepsiCo were like $1,150. That's going to eventually be paid back to us. And hey, hopefully the market will crash and we can get everything else cheaper. Now, if you're bored out of your mind, you have nothing better to do, and you want to poke around this spreadsheet for whatever reason, I'll have a link in the video description below. And now for the company that I am hoping to buy in 2025 as it gets a lot closer to my buy price is Rollins, ticker ROL. They're essentially Orkin, biggest pest control company in the United States and Canada, I believe. So Waltham Pest Control was founded in 1893. Now in 1901, Orkin, not to be confused with Orko from Masters of the Universe, began when Otto Orkin, the Rat Man, sold poison door to door. And then in 1964, Rollins bought Orkin for $62 million and started trading on the New York Stock Exchange in 1968. So Rollins is in 71 countries around the globe, and they do a lot of acquisitions. They like to buy their competition as they see them starting to get bigger. But some of their featured brands that you might know are Clark Pest Control, Crane Pest Control, got Critter Control, lots of controls. Mosquito shout out to the first woman-led company in Rollins, and they're based out of Marietta, Georgia. And then, of course, we've got the big heavy hitter responsible for most of the company's revenue, Orkin and Orkin Canada. We even got Orkin Australia going on there. They also do a lot of termite control. And there's the OG of the Rollins family, Waltham Pest Services, which again was founded in 1893. And what I love about this business is it's very easy for me to understand. I have been in the commercial and industrial loading dock equipment industry for over 25 years now, and all the warehouses I go to, I see Orkin Pest Control products. Yes, there's some competitors, but especially the food grade processing and distribution warehouse facilities, they're everywhere. And that is not going away because the FDA, they require that they have those documented records. Every quarter, they have to come and ensure that the building is pest free. And that is a great source of recurring revenue for Rollins. And speaking of recurring revenue, check this out from MarketScreener.com. Insect and deratting services to residential customers, 45% of revenue. Insect control to companies which are operating in the agri-food, health, catering, food distribution, that's my neck of the woods, and hotels, 34%. Termite exterminations bringing in 20% of revenue. And the United States accounts for 92.7% of net sales. So now we're over at simplysafedividends.com, which, by the way, you can have a 2-week free trial. I'm not an affiliate, but all you have to do is go to simplysafedividends.com and give them your email address. No credit card, no nothing. You get a 2-week free trial. The dividend safety score is 83, very safe. Just a great recession-resistant business. 19% 20-year dividend CAGR, 17% the last 5 years, and they raised that dividend 10% in October of 2024. I love to see that. They raised the dividend 10% and the stock keeps falling. Well, of course, I'm waiting to buy, so it doesn't affect me yet. Rollins is currently paying 66 cents per share annually in dividends. Now, according to Simply Safe, they have an expected share price of $46 to $56 And the current price as of this recording, $46.04. So they are saying that it is about reasonably valued. We like to see the dividend yield being above the historical norm, which at 1.43%, it is above the 5-year average of 1.2%. And the forward PE ratio is 42.4, which seems expensive, but it is below the 5-year average of 46.9. And the 52-week price range, it's been as cheap as $40.95. Now we'll move through these financials quick, pause the video, zoom in if you want to get a better look at the 10-year trends here. The free cash flow payout ratio, 54%, which is low, but higher than it has been at any time in the last 10 years. Free cash flow per share continues to be at an all-time high of $1.11 and projected to be $1.26 in the next 12 months. But when you look for a strong company, look at all of these numbers. They're just always going up and to the right for the most part. And going back to 2018, except for the Black Swan event of 2020, they've had almost double-digit sales growth every year. Every single year over the last 10 years, the total sales just keeps climbing. Last 12 months, $3.31 billion, and they are down to 484 million shares outstanding. All of their margins just super high. Very well-run business, 30% return on invested capital. Free cash flow margin, 16%. That means 16 cents out of every dollar coming in the business is making its way to free cash flow. And of course, you know, broken record, with free cash flow, you can pay a dividend, carry it as cash on the balance sheet, buy back shares, or reinvest into the business amongst the major things you can do with that. So very nice to see that. Their net debt to capital, 37%. Their debt is very low, as you'll see here in a minute. 37% net debt to capital. And the interest coverage ratio, this is how many dollars of operating income or EBIT, earnings before interest and taxes, does a company have to cover every $1 of interest on the debt? Currently, $20.99 of operating income to easily cover every $1 of interest on their debt. This is at finchat.io, where I like to check in on the return on capital employed, which Russ is an important number because it tells us how well a company is at using all the debt, all the equity to generate a return. So currently 30.62, some great investors like Pulak Bursad like to see a 5-year or 10-year average of 20%. So currently for every $1 invested in Rollins, they're receiving almost 31 cents, which is just outstanding and shows that they probably have a durable competitive advantage, and they have a skilled management team. And the benchmark you at least always want to be beating with return on capital employed is the 10-year treasury, the risk-free rate, right? Which as of this recording has jumped to 4.56%. So it's what, almost 7 times the risk-free rate. If you got a company and the return on capital employed is 4%, I don't know why you would invest in the business, because you would have a much safer return and higher return just by buying the risk-free treasuries. Hey, and Morningstar gives Rollins a fair value of just over $37, but my target price is right about $40. So when we see that $40, $39, $40 range, that's when I will indeed start picking up Rollins if I can sit on my hands for that long. Now, if you're nutty enough to sit through all of this and you want to sit through some more, hey, in this floating little box next to my head, I shared all of the 2024 dividend and option income, which was over $8,000. So if you want to see how we achieved that, click this floating little box. And if you do that, we will talk to you there.